16. So far today, we have 16 people in the room, as well as ourselves. Is that right, Rita? 18 with us. So, anyway, let me hand you over to Tom Williams.
Yeah, hi everybody. Yeah, Tom Williams here, speaking to you from England. A nice little resort town on the south coast of England. The sea isn't too far away. It's gone very cold. Of course, it's been raining in this country a lot. There's floods, many little towns and that all flooded out, but still, we're all dry and we're all dry and warm, I should say. And anyway, welcome to our seminar. Thank you very much for joining us. Now, what we've got up here on the chart is 1 hour chart. Can you all see that? Can they see that?
Yes, they've got it.
They've got that right. Now, I mentioned this business about shakeouts before. It's a ploy to try to get higher prices, to generate higher prices. It usually works. Now, that shakeout you see to the left there, it's very crafty and very cunning, because they've done that when most of the people are asleep. And of course, it's easier for them in some middle of the night to do that, because there aren't many traders around to take any advantage from it at all. But it's very, very devious, look, isn't it? Just shows you how cunning they are. Okay, but a shakeout is designed, obviously, to catch as many stops as possible below the market, so you have a chance to buy into the market at cheap prices. It will encourage people that are long to panic, those that are looking at it, and so on and so on. There's many, many reasons why they have these shakeouts. Now, we've seen in the past several weeks or months that the market has been tend to go up on the back of shakeouts. There's been at least 3. And they do have these shakeouts, even intraday. Sometimes they have them. We saw one a few days ago, I believe. And whenever you see a shakeout, you can normally expect higher prices. Now, admittedly, on this hour chart, it hasn't responded up very much. Now, when I say you would expect higher prices on the shakeout, that means you expect. Now, if it doesn't happen, right, or is reluctant to happen, surely that's telling you something as well. Is this telling us that the market's so weak that it can't really take advantage of that shakeout? So you want to bear that in mind. Now, right to the right-hand side of the chart here, right, we do have an automatic sign of weakness, look. That's when the market opens. You see the surge of volume here. When switching from Globex to actual trading, the trading pit's opened. The volume is very high. Well, that's normal, because this volume is comparing it with the Globex. So it always looks very, very high at first. However, that looks like a bit of an upthrust, and the computer spotted it as an upthrust or a sign of weakness. It's really supply swamping demand. And markets just drifted off a bit from that. Rita, can you put that 7-minute chart out?
7 minutes.
Now, this is a 7-minute chart. There's no reason why any particular time frame is important, because they're all important. You need to check them. But I put up a 7-minute chart casually rather than a 5-minute, either 5-minute or 10-minute, but 7 minutes. And you can experiment with these time frames. It's quite interesting, because this is if you look at the top here, look, there's the top of the market, right? Which was, what time was that? Any idea?
This was about 15:20 in the UK. So this would have been nearly an hour after market open.
Oh, yes. Yeah, of course, yes. So the American market's open, look. It's running live, so it's ticking. So the American market has actually opened. And it's come up with these signs of weakness, look, automatic.
Potential buying climax.
A potential buying climax. Yes, it's obviously supply overcoming demand. A true buying climax, I'd like to see volume much, much higher than that. But read those dialog boxes. Philip Friston re-edited all those boxes, has done a very nice job, and there's a lot of information in there for you. And the very next bar, if you're not happy with the first one, there's another one. Now that's classic sign of weakness as far as we're concerned. That is what we call a setup, right? No demand is when the market's marked up. The volume is obviously very low, showing that the professional money is not interested in the upside of the market. If you think about it, it can't be anything else. That's what it has to be. And the computer, don't forget, these rules have been working for many, many years like this, and they will be many, many years in the future. So you've got no demand. Look, immediately after a sign of weakness. Right, so that's very, very important. That is a very nice setup as far as we're concerned. Right, so keep that in mind, because when you see that, you can short that definitely. Okay, so market falls. There's a blue up bar, but look, it looks almost like a bit of an up thrust. The volume is quite low. Right, there's no enthusiasm there, and the reason is, of course, professional money are fully aware that this weakness is right behind them. Right, there's no reason to think that the market's going to go up there, and that's why they withdraw their interest from the market. And if they withdraw, there's no way you're going to get higher prices. But that no demand is based on this, right behind you. And of course, to some extent, this over here, but we won't get too complicated and talk about that at the moment. Mind, that area will come in useful when we eventually have a point and figure chart. But that's no demand, classic. And the reason it's there, look, it's been marked up, closed, below the middle, look. Volume is low. And the reason it's there is because this, right behind you, you've got this ugly scene right behind you. Well, it's ugly for higher prices, but to us it's joyous because we can short that. And you see that very, very often. Market falls readily on that, look. And even here, look, it's repeated. Look, there's another one. Blue up bar. They all look slightly different. This is closed just off the top. The volume is still very low, look. So you know you're going to get lower prices. Okay, so the market falls on that. However, right here, I'll just move forward so we can see where we are, look. Right on this bar here, or this bar, look, there is some stopping volume, look. Right there, look. Now, why is it stopping volume? It's stopping volume because we're vulnerable. The market's fallen from quite a high spot as far as we're concerned. Down to here, it's in fresh low ground, right? It's a widespread down. It's closed well off the low. The volume has it definitely increased. That's stopping volume. Now the next bar also is down, but look at the narrow spread. Professional money know perfectly well this previous bar is there. They're fully aware of that. And then you've got this narrow spread down, and that's produced signals. Now that's very accurate, actually, very accurate. That signal is telling us that there's little or no supply in the market at the moment. Now when we talk about supply, we mean supply from the professional money, because they're the ones that you've got to watch. We're not interested in mine, Rita's, or anybody else who's trading. What we're following is so-called smart money that trade 5,000-6,000 contracts normally. And this is that's why you get the increase in volume like this. It's down a fresh low ground. The very next bar, look, is down on a narrow spread. That's very, very important. Don't forget, it's called volume spread analysis. So we see the volume, look, or the activity is very low. It's a down bar, narrow spread. So we know there can't possibly be any selling there, not selling from professional money. And of course, they're basing that on the fact is that the market's fallen down to this bar here. The market's vulnerable. There may be, well, there will be, a professional group or groups have decided that they may be able to make some money here. They're not going to have a huge bull move, but they're expecting an up move. The market responds up, a couple of bars, look. We don't expect any enthusiastic up move because we're looking for a test of this level of volume here, right? So we expect a couple of blue up bars or so like this, and you could see this one here. There's not a lot of enthusiasm for the upside at all. It's closed almost in the middle. Look, volume is nothing much to shout about. Next bar's down, down. Little bit no demand, down. Little bit of an up thrust. That's normally what we call a weak bar. And this is falling now. Now what we want is that where this original stopping volume was, here, we're going to draw a line across there, look, along the low of that bar there, and even this one. If the market falls, it's gone pretty close at the moment down to that line, and the volume is low, then you expect some sort of up move. Now that's a setup. Now, admittedly, there's a yellow box there, but the thing is that the bar hasn't closed yet. What we'd like to see is the bar to go down, touch that line. Mind, this previous bar is pretty close. And the volume is, yes, not exactly, I'd like to see it lower than that. But it's not exactly high. And then if that happens, you would expect that market to go up until another force arrives. Don't forget, we're looking for fresh forces to arrive on the battlefield. Just as I described last week, the film I saw, the Battle of Waterloo, where the Duke of Wellington was on one side, fighting Napoleon Bonaparte on the other. And the battle had raged most of the day from one hill to the next hill, capturing a farmhouse, then losing it, and so on. And about 4 o'clock in the afternoon, the Duke of Wellington said, "Where is my army from Prussia? They promised me." And nobody liked Napoleon Bonaparte. He was a dictator. And then suddenly the Prussian army appeared over the hill. And that changed the balance of supply and demand. And then that allowed Wellington to win the day. And Napoleon was defeated at Waterloo. And the same thing happens in the market. Forces come and go. And it's the professional money pulling money in, pulling money out, buying the market, shorting the market, supporting the market or not supporting it. There's a whole lot they're doing there. But that's what shifts these markets. And once you learn to, or you can read that, don't worry if it's not all readable. Big deal. So turn the page, look at a chart, or get different time frames up. That helps. Because sometimes you may look at a certain time frame and it's not all that clear. But you suddenly switch to another time frame and there's a lot jumps out at you. Now, it would not surprise me if that previous red bar though was not the bar that's all they were looking for. I'd like to have seen the volume pink. I'd like to have seen it so low that it became pink. But it appears to be responding. So the fact is it dipped down to that level where that low was, and there is little or no supply present. Now they very well have another go at this low. But at least if you learn to recognize these principles, right, then your skill as a trader will kick in. And then you have to ride that move. And of course, once you're in, you glue to it. Never leave a trade running. And you watch it carefully. And then you're looking for other forces to come or go. Or you may have another test somewhere up here where they've a new force for the higher prices has arrived. Now, please, any questions? Type them in. Rita's glued to the other computer.
While Rita's looking at the screen to find some questions, just reminds me, Tom, talking about the Battle of Waterloo, as it was called, between the French and the British mainly, with a few others there. When the war or the battle came to a conclusion, the British won, of course. But Rothschild, there's a chap called Rothschild whose name still is in banking. He had it arranged so that a dispatch rider would rush back to London, or several of them, and tell him what the outcome was. And so when he discovered the outcome, this is how the story goes, I wasn't there of course, he went into the stock exchange and said, it's very bad news, it's over, the British have lost. And he started very visibly and publicly, if you like, in that forum, flogging or selling his shares. He's getting out of the market. So of course, everyone would have noticed that, or many people would have noticed that, so they started doing the same. So the market dived. Now when it had dived sufficiently, he and his friends stepped back in and bought. That's the story that apparently is true, but of course I wasn't there to give you that first-hand information. Rita, any questions? No questions so far. Anybody got any questions they'd like to type into the questions box for Tom? We can look at some end-of-day stocks if you like, or any principles for VSA.
Look at gold, says Jamie.
Jamie wants to look at gold, okay. So, we've got the continuous contracts here somewhere. GC.
Down.
Thank you, Rita.
Is it up to date?
14th. No.
Oh.
Sorry, we didn't update this, so just bear with us a moment while we update that chart. So Jamie's after gold. So we've got the gold contract there.
Colin says it's nice and sunny and warm here in Australia.
Wow. Yeah. Colin's saying it's, have you heard that? Colin's saying it's nice and sunny in here, Australia. Which part of Australia?
And what time is it?
Yeah, and what time are you, Colin? Here it's in the UK it's 1800. Right, there's the gold chart. That's an old line. I think we drew that last week.
Basic test.
So yesterday it's describing it as a basic test. I'll hand you over to Tom.
Now, this is the end of day, right?
Let's just quickly go to the Unless they stop trading, then or something. I don't know. Reload data. 20th, which was yesterday. And this is the SLV. Why are we doing that? GLD. Sorry. Reload data. What's the name anyway? Now this is GLD, which is the a gold derivative. It's yesterday's chart.
So, that
What was that previous chart we saw?
What? This one here?
Yeah.
Well, it's not up to date, unfortunately. It's got.
press it again.
Yeah, we'll try. Try once more.
I think it is up to date because the chart looks similar.
It's 10 to 5 in the morning in Melbourne.
As a matter of fact, there's so much interest in gold, perhaps we should pay more attention to this and analyse it more, and even talk about it in our newsletter. But
just reloading the end of day chart in case it comes out correctly. So just stand by, please.
Peter saying stand by for a moment.
Tell them it's 10 to 5 in the morning
We're in Aussie.
in Melbourne, yeah.
Oh God. 10 to 5 in the morning. Well, congratulations
He's very keen, obviously.
to the Aussies.
Right. Now, this is
Ah.
up to date to yesterday.
Oh no, that's changed somewhat, hasn't it?
The gentleman's saying there's been a lot of action this week and he wants your thoughts.
Right, on gold. Well, it's come up with a signal, look,
Shakeouts.
calling this a shakeout.
2 bars previously was no demand as well.
You've got a sign of weakness there. We are obviously in a downtrend, but you see, I wouldn't advise you to touch gold unless you're already short, until you see a clear principle that's telling you it's going to go up. That we don't see at the moment, because you're not going to get a gold chart fall like that and then suddenly go up. It just doesn't work like that unless it's a huge shakeout of some sort, which obviously this isn't here. Right, so what you need to do is to see the strength coming in. Now, that's come up with an automatic signal, excuse me, telling us a shakeout, which is possible. But what you need to see now is it oscillating a bit sideways and then falling back down into the area where we saw the volume originally. And the volume is just what you need to do, just as we're describing the chart on the 7-minute chart. We're looking on the S&P 500. That's what we're looking for. That's when you go in. But if you try to guess these markets like this, you're going to get whipsawed, because these markets are not there for your benefit. As a matter of fact, they're devious, they're cunning, as we saw by that shakeout on that hour chart. They're there to gun for you, get rid of you. They're not there to help you. They're not there to give you any money. They're not there to help you at all. And when you think about it, why should they? You could draw a trend line, Peter, on these two highs here.
Should we get rid of that line?
Yes, well, the idea of that line was that's a sign of weakness. Whenever you see a huge widespread down like that, look, as it plummets through former area of support on a slight increase in volume, it means they're still going to have lower prices. And that's a principle that seems to work. But Peter's just going to remove that line for now.
And then what, top here?
Yeah, first two highs. That's right. That one and the first low here. Yes, make sure it's a red down bar. That's it. Now we are oversold. When you fall below the trend line, it seems quite a very reasonable trend line, look. And actually, that's another. When you see these wide spreads, as it races towards the former area of support, in this case, the trend line, look, which was invisible at first because we hadn't drawn it, that's also indicates lower prices. Now here we are oversold. This could easily now pop up.
Jamie says that so far today it's a reversal bar.
Oh, Jamie, so it's gone up today.
Yes.
Right. Okay. So it could easily now. Janie says that it's a reversal bar because we can't see today.
Up to sort of there.
Yeah.
It says 1650. Yeah, where your cursor is.
Right. Well, that's a resistance to the top. If it's bullish, if they're going to go up a bit, you'll find it should penetrate that lower trend line, because don't forget that lower trend line is a resistance level. It's a resistance level to down prices. That's why they have to rush at it like this or push through it. But it's also, they have to almost gap up through it from the underside. The trend line becomes resistance to down prices, but resistance to higher prices as well. I'm not quite sure why. It's the way human beings work. And I know there's a lot of traders trade on these trend lines, a lot. So right now, I would not be interested in expecting that to go up too far. If you're scalping, in other words, you only want to be in for a few hours or so, or a day at the most, then perhaps, yes, you might say, right, I'm going to go long on that bar. But you certainly wouldn't go long for any long-term vision on that gold. Okay? Any?
Okay, I'll just speak. Well done to Jamie, who says that he's been short on gold from weeks ago. So he also says here, I'm looking to add to my short at a slightly higher price. Just wanted to know if you thought it was still weak overall.
Well, there was some strength came in, obviously, yesterday. And as we can see on the chart. And, of course, you are over sold. So you're vulnerable to some sort of up move. But see, once you can read these charts, then your skill as a trader kicks in, because there are so many different ways you can trade these markets. It'd be impossible for us to tell thousands of people what to do, because obviously that can't possibly work at all. Shall we put up the 7-minute S&P again, see what's happened? Yeah. Right, so we did have some higher prices, look. So obviously that fall down to that area on that bar there, look, where we saw the strength coming in here. There's your stopping volume. Right, there's signals there. Now, if we draw a line, more or less, which we had done, across the lowish part of this, look, especially this one here, it's gone up. We're looking for a test. If it's going to go up, it will test. Right, and there's the test, look. right there, look. The red bar, it's fallen down definitely into that area, look. And then we look at the volume. As I said, it would be nice to see it pink, but it is low, look. We look at relative volume, it's low. And don't forget the spread is narrow. Don't forget it's volume spread analysis. And when you get down bars where the spread is narrow, especially closing in the middle like that, there must have been support there to do that. It's gone up at least 3 bars on that, look. Now the thing is, as a trader, now you see this setup, no end of times. You see exactly that going on. I see it every day on different charts when it wants to go up. So if you learn to recognize these what we call setups, right, and then have the guts to go in on that, because it can't fall. If you think about the logic of it, this bar here, the market can't fall on when it's a narrow spread closed in the middle and the volume's lowish, and you've got this in the background. It's like sitting on top of well, I was going to say to sit on top of the ice. I don't know. That was some old teaching from the SMI Institute, I believe. But forget about all that, but look at the principle. So it can't possibly fall, can it? I mean, you have to have power. You have to have push down. That's why those wide spreads down, closing the low with an increase in volume, shows you downside pressure. But here there's no downside pressure, look. It's a narrow spread, now closed in the middle, the volume is low in an area where there was support, look. There's the high volume came in. And that's why it's gone up, look. So you go long on that, you make money, look. Question?
Jamie, can you just specify which bar you're asking that question on? And while you do that, Malcolm is saying, with a signal like this, how confident would you be that the initial stopping volume bar, before you see a test, would not be broken to the downside as opposed to being ready to go up, where a successful low volume test clearly would be required? With a signal like this, how confident would you be that the initial stopping volume bar, before you see the test, would not be broken to the downside as opposed to being ready to go up? Whereas, yes, that one. Peter's just explained. How confident would you be?
Well, I was just trying to explain to me, you can have all the confidence in the world. Because, that's the chart there, is it? Yeah. I mean, there's the stopping volume, look. Right, and we've seen a down move, look. Huh? Just click on the chart, that's it. Right, there's the stopping volume. Now that's clear, isn't it? You can see that, can't you? There's the high activity. You've had a down move up here, so market's vulnerable. Not only stopping volume, it's dipped down to fresh low ground. It's closed almost in the middle, look. Right, so you see that. And the next bar, look, is down. It's almost testing that previous bar, and the volume's gone. And we come up with signals, that's why. No supply, look. Now, that's absolutely clear. You can't get clearer than that. And if that's not clear to you, you better restudy. Okay. So once we see that, then right, goes up, look, fair enough. But what you want to see is a test of that volume before you get an up move. So the market's looking, there's an up thrust, look. But the market falls here, look. This is the bar here, look. This red bar, look. It's down, narrow spread. It's back to the level here, look. I'll draw the line again, look. It's tipped, the toes tipped back down to this here, this area where there was this high volume. Now, if we look at the volume, look, the activity is very low. That means that the supply that was present here has disappeared. And that means that because the market works on supply and demand, there was supply here, it's dipped back down, now supply is gone. That means it must be bullish. Now that's as clear as anything anywhere. And you should study that and understand it, because you see that set up time after time. And that's why it's gone up very few bars. And you can trade that. You can jump on board and you can make as much money as you dare on these up moves like this. Is that clear? That makes sense. Very, very important.
Yes, it does. So Jamie's asking, are the last dozen bars or so what you'd call a Wyckoff spring?
No, it's not a spring. It's a test of supply. A spring is where they try to shake you out before an up move. That too you have to recognize. But it'd be the same principle, right? Except that they mark it down heavily to catch stops and all that just before they have an up move. But this has nothing to do with springs, look. That red bar there, right? It's so clear, it's frustrating for me if you can't see it. It's so clear, look. It dipped back down to this level, this area. And the volume was high here, look. Now the volume has disappeared. So that means that there is no supply present. It's got nothing to do with a spring as such. And then bang, up it goes. Very, very important. Matter of fact, perhaps we'll show this chart in the newsletter so you can really study it.
Yes, a spring is one of those bars at the bottom of the, if you've had a down move, and it's one of those bars with a long stick down and it closes right up on the high. It's sort of like a spring. That's what a spring is. Yeah. Okay. Malcolm, with regards to his question, Malcolm, I don't understand, but I'm sure that Tom might. Thank you. You've answered Malcolm's question. It's clear. Thank you. The intent of the question was to evaluate selling a put spread below the level of the stopping volume bar as soon as you see it to take advantage of volatility crush as well as theta decay, which both will be better if you don't wait for a low volume test. Tom? He didn't catch any of it, so shall I say it again? The intent of the question was to evaluate selling a put spread below the level of the stopping volume bar as soon as you see it to take advantage of volatility crush as well as theta decay, which both will be better if you don't wait for the low volume test.
So he's selling.
Yeah.
Yes, that's where your skill as a trader, and you sound as if you know what you're talking about. When you talk about selling a put, that's wonderful. And as long as you don't stay in there too long, and you should do very well. Thank you very much. Actually, VSA is ideal for buying and selling puts, especially on the short term. we got quite a few people that trade puts and calls. Some buy, some sell, and usually they tell me that once you're in a successful move, don't stay in it too long. 3 days is a maximum, usually, that they stay in. Because, you know, don't forget those puts and calls are written by professional houses in London somewhere, and they're certainly not going to give you anything if they can help it. And of course, one trick they do is they allow lots of expiry time on the put or call. So even though you may be making $800 or something in the first few days, you think, oh, wow, what will I make if I stay in 6 months? You know, that's a fallacy, believe me. Because normally they're so clever at writing these puts and options that the ordinary trader doesn't usually stand much of a chance.
Just add to that about those options, if you're not aware, some traders use the last week, you know, the expiry week, if they're into options, because the time value has diminished such that they're cheap relatively. And of course, as Tom says, you don't stay into an option for long, even in that last week. That's my experience. Rita?
Malcolm also adds, or selling spreads. All you have to know is where the market won't go, which puts statistics on your side. Tom agrees. Thank you, Malcolm. Chris wants to look at IBM 15-minute. Tom doesn't have intraday charts for IBM, but I've put the daily chart up. This is the daily chart, Tom, to look at for Chris. I'm sorry about that, Chris. We'll look at this and then.
You just have to click in there in general. If you do that, you alter them.
That's it.
So. That's a daily chart, is it?
Yes, of IBM.
Right, this is an IBM chart. I think as I've said before, normally when you see these gap downs like this is not a healthy sign. IBM's obviously a high caliber sort of stock, but you do have weakness at the top here. Now it's been falling for some time. It's oscillating now, more or less up and down. Look, this looks like a shakeout here at the low here. And on that shakeout, it's gone up a few bars. It does not look as if this is a stock that's accumulating for a big bull move. It looks as if it's going to carry on oscillating up in this sort of trading range. You could draw a trend line across there, Peter, those two highs and that low. Peter's going to draw a trend line. It's usually a good idea to have trend lines, that's it.
Chris says the 15-minute had a massive wide spread. Looked like a similar situation to what was being discussed, but much more aggressive.
What, down or up?
He doesn't say. Ask Chris. Is it a
What's
wide spread down or up?
Well, that's important.
Chris, was it a wide spread down or up?
Oh, we want to know if it's up or down, the widespread.
Yes.
I mean, vast difference there. One's night, one's day. Any result yet?
No.
Well, it looks overall, you could see this trend. Although it's going up, it could easily fall down to that lower trend line, look. Very easily. That very last bar there doesn't look all that strong, does it? And don't forget, this stock is not acting stronger than the index. For a bullish stock, you need to make it clear that the stock is acting at least as strong, if not stronger than the index. And then when the parent market decides now's the time to be bullish, then stocks acting stronger will rally faster and harder than those that are weak. And that's been proven. There's no such thing as a bargain in the stock market. Keep that in mind. You might ask, say, the trader in the street, how would you select a stock? And they automatically say, well, I'd love to have a stock that's $10. It was $200 a year ago, and now it's $10. Because that's got to be a bargain, because when it goes back up, I'm going to make a lot of money. But that is wrong. There are no secrets in the stock market. The reason it's $10 is there's a reason to come out. And that means that the stock will not rally until all sorts of things have happened. So you go for stocks that are acting stronger than the index, and you analyze the index carefully, and sometimes you can see easily when it's going up or down. The index.
Yeah, Peter actually got that chart up on his computer, but Tom can't see that. Yeah, it was a down bar, Tom. It was basically like it's a shakeout like we've had on the index, on the open, yeah. But of course, it actually looking at the chart, it hasn't done much. It's not done much. It's similar to what we were looking at on the hourly chart of the ES. Do you want to say something, Tom?
It will trade in harmony with the parent index. If the index is prepared to go up, then this stock will go up. If the index is weak and is falling, then this will fall. So you need to learn and study that. That's why I always show, if possible, the daily index. In a newsletter, we usually show the Dow or the S&P and the S&P 500, the NASDAQ. Right, it's not too bad, jumps around a lot, but even that will follow the main index. You see, the equity or the strength of the market lies in the S&P 500. That's where the strength is, and that's why we look at it carefully.
Okay, Edmund would like the NASDAQ daily chart. I like the NASDAQ. It's always interesting. There's the NASDAQ, Tom.
Well, this will move in harmony with the other indexes, but sometimes it's easier to see. I mean, if you don't recognize that as a sign of weakness, up front, you should pack your bags and go home. Don't give up your day job, Peter says. Sorry about that. But it's right. Look, that's sign of weakness. And look, if you see that, ever see that, you know that's a weak market. But the market's devious and cunning. It's not there to help you. And that's so they say, right, so we're going to have an up move here. We'll put the fear into you. And there it is, a market up, look. It's a black bar, meaning it's level. Well, it can't be level, can it? Why is it black? Oh, it's blue. Sorry, I can't see very well. It's dark blue, look. And that is really no demand, look. It's closed off. But the reason why we look at that and say that's a weak bar is because this is right here at the same level again. It's very important that you look at these levels. if that was a sign of weakness there, and then you've got this bar over here rush straight into it, right? Especially when the bar is on lowish volume, and it's, eh? Let me have a look. Peter says not really low volume. Well, that's all right. Doesn't matter whether it's no, he's right. It's not really low volume. That's low volume there. But there is an increase in volume here, right? It's suddenly gone up above the average line. And on that increase, lo and behold, it's closed in the middle. If that increase in volume was bullish, surely it would close at least on the high. So that is a sign of weakness. And especially when the next bar's down, look. And this bar here has got top tail, which also spells weakness. When you see these down bars and they have what we call top tails, that's built-in weakness. And here's another one here, look. Okay? So it's all there. I know it's easy in hindsight to see all this stuff very clearly. But if it's there in hindsight, it must have been there originally at the leading edge of the market. If it's not clear to you, look at a different chart. Look at the Dow or the S&P 500 or the future. They will tell you information perhaps where the other chart hasn't told you much, or it's clearer. So you've got 4 charts to check on.
Right, Christos has got a question here. Should I go long if the market goes above a sign of weakness and short if the market goes below a sign of strength?
No. In a nutshell, that's gambling. That is not a good way to trade. That is not a good way to trade. But I could see your thinking there. You think if you get a sign of strength and the market fails and falls, right, it must be weakness. There's a lot of truth in that. But you need to identify, if you're going to go short, you need to short on up bars. And you need to be ready, poised to do that. And you can see the weakness on the up bar. The weakness in the background will be there. And as the market goes up, usually on no demand or ultra high volume, closing in the middle or something, especially if it's narrow spreads, then you can short those and you'll be sitting pretty then. But the other way, I can see the way you're thinking, but I certainly wouldn't ever do that. I like to be more certain of my move than that. I thought you'd be doing a bit of gambling there.
Just getting some. I'll get there in the end. Hang on. Get there. Found it. We were talking about springs earlier, and Edmund says on this chart here, November 16. That's not a spring. Where's this? Yeah, no. Well, no, that's Tom. Yeah, he's saying that's spring.
Now, when I first started instructing this program to the programmer, I didn't want to use terms that would sound confusing to people. I wanted to call a spade, in other words. And that's why you don't see the term spring and crossing the creek and all that stuff in the program. A spring, the original description of a spring, was usually associated with a stock. And you see the stock fall, yes, you get stopping volume or climatic action. then it churns sideways, right, for some time, right? It can vary the time it goes sideways, right? We don't go on time scales, we don't go on formulas or anything. It can go sideways. Then when the professional money have accumulated enough of that stock, right, and they're ready for an up move, then they mark it down heavily as far as the market will allow them to, right? Catch as many stocks, mislead as many people as possible, then reverse on that, and then allow their bull move to start. And it's almost like this bar here, look. That, there. That. There, look. That's what a spring, but a spring goes below the area of accumulation. This is just simply a test and shakeout and an uprising, up move. But you'll see that with a stock and share, once they're in control of it and absorbing it and building up a cause to go up, then there'll be a fairly tight move sideways for some time as they accumulate. And then when they're ready to move, then they have a bar looking like that, which we've just seen. Looks like this. They ram it down, catch as many stops as possible, mislead many people, and then up they go. It's similar looking to that, but in this particular case here, look, this is just simply a shakeout in an up move. Does that make sense?
Yes. Okay. Fine. Oh. Right. Hang on. Yes, Edmund says thank you so much. Yes, it's clear. Oh, we have two questions left, and we'll start with the euro question. Can you put euro? Or shall I do it? 5 minute. Got that, haven't we? Currency. Right. This is the euro 5 minute, Tom. Do you want 20? Is that enough or not? Or do you want, there's 30? Just putting up the bars so that Tom can see it better. Abraham is asking, it looks like this is what you are talking about on a small time frame. The volume appears to have dried up on the down move. Is that, does he mean there? Do you mean there, Abraham? Big volume on the initial down move. No, hang on. Just look at, if I put up more bars, then we might be able to see a bit more. More. Here's our big volume here. Is that what you're talking about? Yeah, 1440. Yes. So, okay, there's big volume there, Tom. See, the trouble is Tom has to have far less bars so he can see, but he's having a look anyway. There's our big volume there, Tom. Oh. Is that in the same area, Peter? All right, that's the one. Oh, yes. There we, yeah. That's the initial volume. It went up. Tom's just studying the chart.
Well,
you need to put your ears on.
I mean, you're quite right here. It looks like stopping volume, right? Then churn sideways for a few bars. And there's a down bar, look. It's colored black because it closes level down. and the volume seems to have disappeared. And that fact is, that's happened, allowed this to go up, look. At least 1, 2, 3 bars. But it's hit some sort of problem up here, look. The program has detected supply. Now, okay, there's an increase in volume, but it's also looking, the fact is there's a sudden increase in volume, and the spread has narrowed somewhat, look, and not only that, it's closed in the middle, and the next bar's down, so that's why it's saying that there's supply in that bar. And it's obviously been proven correct, look. I say to Gavin jokingly, ignore the signals at your peril, because very often you can get cocky when you're trading. You think you're getting really, really good, and you carry on and say, oh yes, this, that. And I say, wait, hang on a minute, Gavin. Look, you just said you're going long, and there's a sign of weakness right there. So ignore the signals at your peril. You need everything in your favor. It's so devious. But there was some stopping volume here. And there was a test there, look. And because of that, you did get an up move. 3 bars. Look at this crafty bar here, look. Look. There's even a signal on that, look. Yellow bar.
Had it been an up bar following, it would have said, oh, it's one of those dodgy ones. It's wrong. No demand.
Well, you know, but the thing is, it won't come up with a signal. There's less bars confirming it. But you've got these, but this obviously has worked. Next bar's down, and that's why it's fallen off. Sorry. It's still been falling, look. And there's our blue no demand up bars that we were talking about. In these weak markets, you often see a blue up bar, right? And when you've got this weakness behind you and this falling market, look at the narrow spread. Look how it's closed in the middle. And look at that low volume. That's why a signal's come up. Well, yeah, okay. So it calls it an up thrust. It's a bit of an up thrust. You know, the human eye would love to see a proper telegraph pole sticking up there and make it clear, but the computer's not quite so smart as you are. But it's still come up with a signal log. And based on the fact is the spread is narrow. The fact is that there's weakness in the background. The market's been falling. The fact is it's closed in the middle. The fact is that the volume is low. That's what I liked about the idea of a computerized program initially, because usually the weak link in trading is you. I'm sorry, it's a trader. What's that? Oh, sorry, it's running live. So that's weakness. So the market falls. There's a little bit of stopping volume there, look, not much. That's why it's drifted up a bit. This market, there's too much volume around. There's too much volume around to say that's bullish. Okay.
Okay, okay. So yeah, Abraham is saying, Tom, that what you discussed was the cause. He believes it was a cause, and now it's going up. But Tom's saying that there's too much volume. You're right, but yeah, yes, no selling pressure there.
It's not a bullish accumulation area.
But it's not a bullish accumulation area, he says.
but when you see that, it will allow the market to go up a few bars.
But when you see that, it will allow the market to go up a few bars. All right. Okay. All right. We've got to. Okay. What would indicate bullish accumulation? He says.
For true bullish accumulation, you first of all have to see a down move. That makes the market vulnerable to one or more groups looking at it thinking, right, we can make some money here, right? And then you see them coming in to the market. You know they've come in because they'll come in on a down bar. The red bar will be down. The volume will be very high. It'll dip down into fresh low ground. It may close in the middle. But the key to it is it's occurred after a down move. You see the stopping volume coming in. It could close in the middle probably on that. Then it'll start churning sideways. They churn sideways because they could be accumulating. And then you need to look at the individual bars to give you a clue. Because individual bars, you have strong looking bars or weak looking bars, which I'm afraid we haven't delved into all that much. But strong looking bars, when you see down bars, they'll be red, but usually on narrow spreads, usually closing in the middle, and the volume is not high. Weak looking bars is when the market tries to go up, the volume is low, no demand, or you may get little up thrusts, and you know that the market is not ready for a bull move at that moment. Study of strong or weak bars is very interesting indeed, and perhaps we should try to cover that one day.
Christos says thank you. He believes that was a silly question. No question is a silly question, Christos. I often sat and thought, oh, I won't ask that because it might be silly. Actually, you'll probably find that there are other people in the room who've got the same sort of questions. So, but you asking it has brought the answer. So, no question's a silly question. Okay, Jamie, Tom does not have data for UK stocks. Philip Friston does. You could put a chart into the VSA Club forum, and he may well get a chance to look at it. So lastly, Peter is asking, this down move in the ES, is this a test? And I'm afraid he asked it at 6:15, but I don't know what time frame you want. We can go back to that 7-minute, just see what's going on before we finish. But if you want a different time frame, please let us know. Just putting up the 7-minute, see what's been going on. Is that it? Oh yes. Yes, it was a long. So. What time was that? That was at 18:13, he says. Tom's pointing at... Hang on there, Tom.
Was it?
He says 18:13.
Yes, but there's the stopping volume. Is it somewhere around here?
Yeah. Yes, that's what you were talking about.
Yeah. And
that was that.
That's it.
Yeah. But it's saying 18... Well, it was at 18:13 when he asked that question, which
and
was,
that's why it's gone up.
Yeah. 18:13.
Well, it's that principle that we were talking about earlier on, where somebody said, "Is that is that a shakeout or something?" Right. It's that bar there. Look, as it fell back down into that area. And that's why it's gone up like that. Now, don't forget, the computer is automatically updating the data. And sometimes it has to reorganize the chart slightly to fit it into the screen. And I notice that sometimes it gives the data sometimes a slightly different look. It hasn't changed the data, but I've noticed that, so be wary of that, because the principle was there. We discussed it when you first came online, 5:30. We saw it happening more or less live, and you see that principle at work. I see it frequently, almost every day, on different charts. And then once you see that principle, you can go along with great confidence and scalp the market. Anyway, I think it's time now. I'm afraid we have to pack up. And I will say to you all a very, very happy holiday or happy Christmas. I'm not sure whether you're supposed to say happy Christmas or not these days. I mean, when I was young, it was definitely happy Christmas. But now I'm told, oh, you don't say that, you say this, and so, but I'm sorry about all that. But I'm one of these old-timers that, should we say, old-fashioned. But one thing you can be sure of, that I do hope you have a very, very good Christmas, and please study, especially the newsletter that we're coming out with, and this recording will be recorded for you to look at. And so I wish you all a very, very happy holiday. And that we won't be here next Friday, apparently. The market will only have a couple of days or so open, so it won't be a great deal to talk about. We're doing the newsletter tomorrow, but nothing next weekend while we're enjoying our eating, drinking, and merrymaking. So I'll get Peter to say happy holiday to you.
Yes, happy holiday to all of you. Hope you have a good break, if that's what you're having. And we'll look forward to seeing you when we're back, which will be a fortnight today, I think. But don't forget the newsletter. If you've got access to that, that will be appearing tomorrow. So I'll say goodbye. And Rita?
Oh. Yes, Merry Christmas or Happy Holidays to all of you. And we look forward to being back after the break. We'll probably be very pleased to be back after the break. So have a great time, and we'll see you in 2 weeks. Bye-bye.
Welcome to GoToWebinar, Web Events Made Easy.